At today's meeting, my colleagues and I decided to leave our policy rate unchanged. As always, we base our decisions on our judgment of how best to achieve the goals Congress has given us: maximum employment and price stability. We believe monetary policy is well positioned to serve the American people by supporting continued economic growth, a strong job market, and a return of inflation to our symmetric 2% goal. Offering amounts gradually as conditions permit. At some point, we'll also raise the minimum bid rate. The expansion is in its 11th year, the longest on record. Growth in household spending moderated toward the end of last year, but with a healthy job market, rising incomes, and upbeat consumer confidence, the fundamentals supporting household spending are solid. In contrast, business investment and exports remain weak, and manufacturing output has declined over the past year. Sluggish growth abroad and trade developments have been weighing on activity in these sectors. However, some of the uncertainties around trade have diminished recently, and there are some signs that global growth may be stabilizing after declining since mid-2018. Nonetheless, uncertainties about the outlook remain, including those posed by the new coronavirus.
Chairman Bernanke did when he tried to roll it off?
I'll repeat. There is likely to be some disruption to activity in China and possibly globally based on the spread of the virus to date and the travel restrictions and business closures that have already been imposed. Of course, the situation is really in its early stages, and it's very uncertain about how far it will spread and what the macroeconomic effects will be in China, in its immediate trading partners and neighbors, and around the world. Our goal was changing near to returning to, was the fact that we've reached a phase one deal with China and the fact that we've moved ahead closer to getting USMA agreed. Those are potentially positive things for the economy, without question. And financial markets, the reaction of financial markets is very consistent with that perception. A sustained reduction in uncertainty over time should improve business sentiment and investment, which would provide some additional support for the economy. Can lead longer-term inflation expectations to drift down, pulling actual inflation. We do see asset valuations as being somewhat elevated. I do, somewhat elevated. If you look at risk spreads, they're narrow. If you look at PEs, they're high. I think the way to think about, one way to think about equity prices, though, is what's the premium you're getting paid to own equities rather than risk-free debt. And that's also at fairly low levels, but not extremely low levels. So valuations are high, but not at extremes. The final factor is funding risk. Are big financial institutions and other players in the financial system funded with stable funding, or is there a lot of run risk? And the answer is very stable funding. Household spending moderated toward the end of last year, but with a healthy job market, rising